In today's video, I'm going to take a look at some of the triple leveraged funds. Um, I think they're a very good tool to warn of a possible, like an intermediate bottom before a big move starts, and maybe also something to look at as a warning that maybe a rally is running out of steam. So, I've done a couple of charts of the day with these ETFs, and I've noted before that very often, after a long sell-off when sentiment's getting really bearish, that's typically the time that smart money likes to buy, and hedge funds and retail traders, their emotions take over, and they start to assume that the trend will be down forever, so they're selling. More often than not, bottoms occur as an undercut low. I've also gone over this before. The banks will trigger a sell-off to break a technical level that triggers a lot of people's stops, creates a big wave of selling, allows them to scoop up huge positions without pushing price against themselves, so they can take a big position into a down market as everybody else is selling. So the first chart here is the triple leveraged fund on the NASDAQ 100. It's sort of evident here. You can see the volume here as we came out of that 7-year cycle low it wasn't massively above average, but a nice surge in volume here above the weekly average, and if you take into account a couple of these sell-off weeks, we did have some very, very heavy volume, and that signaled the bottom of the rally. But as this rally matures and as retail traders get more and more confident that the trend is going to continue for indefinitely, the volume in this triple leverage fund is starting to evaporate. Probably not a good sign. So I'm going to suggest this is probably not a great time to follow your emotions and just assume that the rally is going to continue forever. I think we're building a lot of complacency in this market, and that could trigger some kind of a sharp waterfall type event at the tail end of the intermediate cycle. And I have never figured out a way to anticipate when one of these crashes or semi-crashes are going to occur. So, if you keep pressing your long side bet here, you're at risk of getting caught in one of those things. In my opinion, it's probably better just to stay on the sidelines and wait for it to happen, and then try and buy the bottom. You have a lot less risk and a lot more upside potential. There might be 1 or 2 or 3 more weeks upside potential here, but then if you don't get out in time and you get caught in the crash at the tail end, then you just end up giving back all those gains anyway, so you didn't do yourself any favors. A little bit more evident here in the triple leveraged energy sector. We got some really huge volume at this bottom as retail traders and hedge funds panicked, dumped their positions. The smart money, the banks, scooped up those shares right at the bottom, and then we've got this nice bull market rally. But we've got what looks like an exhaustion type candle on the weekly charts here, and the energy stocks have just not been able to put together any kind of recovery at all from that exhaustion move, which I think is probably an exhaustion move. And you can see here as the rally has progressed, the volume in the triple leveraged energy fund has started to decline pretty significantly. So might not be a good time to keep pressing the long side, and maybe too early to start buying here. Might not hurt to wait until we get oversold on the weekly charts in the energy stocks before you try and step back into this market. So here's a weekly chart with I just used the weekly stochastics, but you can see that the stochastics have been embedded for a long time in the overbought condition, And usually that's going to require the pendulum to swing back to the other side at some point, probably pretty hard to the other side. So again, as long as this exhaustion candle continues to mark the top, might not hurt to just sit on the sidelines and see if this weekly stochastic can't oscillate back down to oversold before you try and buy the energy stocks again. Now in the metal sector, specifically the miners, we've got the exact opposite happening. So you can see back here at this bottom, and this occurred just like I described. The banks created an undercut low that forced hedge funds and retail traders, technical traders, to sell their shares when their stops were hit. When the miners undercut this low here, that created a huge volume, allowing the banks to scoop up huge, gigantic positions right at the bottom, and then get positioned for this baby bull rally. So I was pointing this out at the time, but most people were, of course, telling me I was wrong and that the volume in the triple leverage funds didn't mean anything. But it does. I think it's a signal that smart money is anticipating a bottom and a major rally, so they tend to buy very heavily in those first few weeks as we form the bottom and then start to move up. So very good indicator here that a big move was beginning. Same thing's happening right now. I think we've got a very loud warning bell ringing here that a big move in the mining sector is just beginning. And it's even more evident in the junior mining triple leverage fund. Now at the January bottom, we didn't see that huge volume in JNUG, but we did see it in Nugget. So there was apparently the smart money was only taking a chance on the majors, and the signal came in the triple leveraged fund Nugget, which is the major gold miners. But this time it's occurring in both, also in Nugget and also in JNUG. And the volume in JNUG is just off the charts. So I suspect over the next 3 or 4 months we're going to see a very large rally in the mining stocks, maybe even something to rival this baby bull rally. And I'll say this correction into the yearly cycle low was so severe, turned virtually everybody bearish. Nobody, it was virtually impossible to find anybody that still believed the bull market was intact, even though gold really wasn't even close to moving below last year's yearly cycle low. And the miners, the unleveraged mining funds like the XAU or the HUI, weren't really even close to taking out their January 2016 lows. But still, the correction lasted long enough that virtually everybody lost faith, and nobody believes in the bull market anymore. So sentiment reached bearish levels that hadn't really been seen in 30, 40 years, and that is the fuel for a big move. We're going to have, and I'm already seeing it. A lot of people are looking for spots to short. So those people, there's a lot of bears still here that are getting squeezed or are going to get squeezed. There are a lot of shorts that are going to try and go short here as this market continues higher. They're going to get knocked out of their positions. They're going to get squeezed. The bulls that lost the faith, virtually none of them have bought this bottom. They're going to end up having to chase at higher prices, along with shorts having to cover all the way up. So I think that extreme bearish sentiment that was experienced at this bottom is the fuel to drive a really big move, just like the extreme bearish sentiment here was the fuel to drive the baby bull rally. So I think there's a lot of potential over the next 3 or 4 months in the mining sector. And we've got the signal here in the triple leveraged funds that the smart money is piling in. They're getting into position for what they expect will be a really big move.